A lot of people are interested in the short-term rental space, and it's a great space to be in. But one of the challenges with it is if you want to be more passive in your investing, it's hard to really do well. It's hard to actually scale up this type of investing. My friend Lance Pederson is here today, and this is exactly what they do. Their business basically works with individuals to do luxury short-term rentals. They have a fund. We're going to basically learn about how it works and really how you can get involved in getting a great return through an investment like short-term rentals. So Lance, welcome. How are you today? Really excited to have you.
Yeah, I'm doing great, Bronson. Thank you for having me. I really appreciate it.
Awesome. Well, I know we connected in the past. You've done a lot of different things. You worked with a group where you guys were setting up funds for people. So if somebody was in the capital raising side, they might be familiar with who you are. But why don't you give people a little bit of background about who you are and what you're doing and how you got where you're at?
Sure. Yeah. So I'm a lifelong entrepreneur first and foremost. So I, like doing things that are hard and starting things from scratch. But I ended up getting into the real estate space through the private lending. So in 2008, with a friend of mine, I got involved. He was doing hard money loans to non-owner occupied commercial real estate assets up in the Pacific Northwest. And that's sort of how I got involved, really in the back office and building that up in fund management. So that's where I got exposure to funds and open-ended funds and net asset value and underwriting and all those things. So I think it's a good place to start when underwriting things that you don't control. You don't necessarily want those properties back. So you want to make sure that, who the borrower is, what their business plan is. You certainly are good at assessing what the value of these assets are, since you're, lending money on a percentage of that, loan to value or whatnot. So that's where I got started. And then from there, we pivoted that business in 2011 into just doing more capital allocation. We realized that, upside is limited, lending out money and money's fungible. Whereas we felt like we could add more value, allocating capital, raising it from high net worth people, and then allocating it to worthy deal sponsors across the country. And so that's really where we got super involved in it. And it led to, forming a fund administration business and a advisory practice. So we realized two things that a lot of real estate guys need help with. They're good at the real estate side, but maybe not so much on the capital management side in terms of, investor relations. How do you raise money? Those sorts of things. And then certainly the accounting is really the bane of most of their existence. They don't like anything to do with the accounting, and frankly, they're usually not very good at it. And so we started doing it for them as a service, really out of necessity, because a lot of people we invested with, we wanted to make sure that our books were good and we could get our financials out and, make distributions to our investors. So that's really what I spent the last, 10 or 12 years doing, is just really consulting and advising with real estate guys all over the country that are executing any number of strategies with real estate you can think of. And I think for me, that sort of by way of segue, how I got into the short-term, rental space is that, I had a client come to me, 3 years ago and said they wanted to put a fund around this particular strategy. And, that's really when I dug into it was through that. Like most of the opportunities, you get to really dig in. If you're going to model it and structure it and figure out how to do that, you have to understand it, which is the part that I like. And so when I exited the private equity real estate firm and the administration business at the end of 2022, these particular individuals, kept phoning me until I would, they wouldn't take no for an answer. Let's put it that way. So I ended up getting involved with them, and they're a great group down in Scottsdale, Arizona. And it's one of the two strategies I was super bullish on. I really like mobile home parks, and I like short-term vacation rentals.
Yeah. I want to just touch, as I interrupt you here. So I have a friend, you might know this guy, his name is Tim Hubbard, and he does a lot in the short-term rental space, but he's done kind of like a small multifamily strategy where he had this story of buying, apartments in Midtown Memphis, like 8-unit apartment complexes. This was like 8 or 9 years ago. And he's buying, average rent was $450. And then he would go and basically do renovations, and he was getting basically $2,500 a month gross rentals with short-term rentals. So the math is just insane if you can make it work. But the challenge is, like, if I'm going to do that, of course I live in California where if the neighbors complain, then you're out, you can't do it anymore. So I know there's a lot of things that go into short-term rentals. And so can you talk to us a little bit about just kind of the short-term rental business. If somebody's not as familiar with it, obviously it's higher cash flow. There's probably higher costs that go into it, just as people understand kind of how the business works.
Yeah, glad to. Yeah, so Tim, he was on my podcast as well, Real Estate Risk Report. So yeah,
great guy.
Good, yeah, great guy. So yeah, I mean, I think the way that this business works, is sort of a hybrid, right, between a hotel and a long-term rental. So you're taking a single-family home and converting it into a more of a hotel, right? Like, so your average daily rents is really one of your key things, and then occupancy, right? So we're always shooting for, occupancy rate. A good occupancy rate in short-term vacation rentals is probably somewhere between 55 to 65, 70%. I mean, any higher than that means you're leaving money on the table. So, the way that it works, yeah, there's more moving parts, obviously, than a long-term rental. I mean, the thing that's constant, of course, is that, maintaining the home. And you need to make sure all the things that come along with that, the landscaping and the roof and the AC units and all that. So is sort of similar to what it'd be like to be actively managing a long-term rental. And then the big difference, of course, is just when you add the hospitality piece to it, right? So, most of the traffic now has been driven by, Airbnb, VRBO. I mean, all these, they call them OTAs, or online travel agents. So, we can list, our homes on, pretty much any travel site out there. I mean, you can go to Google Maps and search, and, vacation rentals pop up now. So, that makes a huge difference. You've got this massive distribution channel that's sending you leads. And in most of these cases, right, what ends up happening is that Airbnb ends up just tacking on their fee on top of ours, right? So to the degree that the guest is willing to pay that extra freight, which often they're not necessarily aware of, then they go ahead and do that. So it doesn't necessarily hurt our economics. Now, what I do on our listing pages, I do everything I can to try to drive the traffic back to our own site where they can direct book and save, that fee. Now, of course, Airbnb, they police that, and Vrbo, they don't want that to happen. So the way that they kind of police the listings, but I use like QR codes, for virtual tours and, things like that sort of drive them back. So they get the gist of it. But that's sort of how the business, works. And then the things that are different too, in terms of the P&L impacts, right, is that your mortgages are obviously going to be the same, and interest for the most part is the same. The difference would be you've got consumables, right? So you actually pay for the shampoo and the soaps and the toilet paper and those sorts of things are cost borne by the owner of the home. And then, but the cleaning and the housekeeping and that stuff is borne by the guest. Right. And I think the other thing that you have to keep in mind is, your maintenance costs are probably a bit higher, just because there's more wear and tear, than maybe a long-term guest, or maybe you're just sort of feeling, the brunt of it more frequently than you do with a long-term rental. But we all know you've owned a rental house. You can have really, really great tenants who take care of it like it's their own. And you got others who, not so much. Right.
Yeah.
So, same thing.
I wanted to stop for one sec here, just because for some people, they may not be as familiar with, everybody's kind of heard of Airbnb or VRBO. Some people travel a lot, and obviously you may be familiar with that. Some people it's business guests. When I've traveled for business, sometimes I'll stay in an Airbnb, and it's nice because you're in a place that's not as cookie cutter. You're not in a hotel necessarily. You have a kitchen, you've got a lot of amenities that you wouldn't normally have. And then, for you guys do something pretty special in the space, that you're not just going after the average business traveler. You're not going to somebody who's, hey, we're just going to Arizona for, but these are pretty high-end luxury properties. Can you talk about the properties just briefly, and then who is actually renting this out? Because it's not just your average person who's renting that out.
Yeah, it's a great point. So, I mean, I think for us, we operate exclusively in Scottsdale, Arizona, which is just east of, Phoenix. And there's a lot of resort travelers and stuff who go there. So we've opted to really focus on the luxury segment, or we'd call, we buy mansions. So we're talking 5,000 square feet plus, acre lots, they're really, really nice, large homes. And for a couple of reasons. One, we just believe that there is just less competition there, right? Not as many people can buy. Whereas, in the last few years, this has really taken off as a strategy for the everyman, which is great, and I'm all for it. But also, it's just the amount of competition in the 2, 3, 4 bedrooms is significant, and it's definitely impacted those key metrics, right? So you just don't do as well in that segment today as you may have a few years ago. But in the luxury segment, we really have only got, we've gone up. I mean, our average daily rents, the amount, the room rent we charge per night, is up 20% from last year. And last year was a banner year because everyone was sick of being cooped up. Now we've seen the average number of nights that people, our guests stay with us has gone down, back to sort of, pre-COVID, 3 nights, 3, 4, 5 nights instead of, 7+ nights that they were doing last year. So yeah, we focus on that high end, and then we wrap, concierge services around that. And the people who stay in our homes are, it's a, super affluent, family of 4 who, doesn't want their lifestyle to change literally one iota from, wherever they live up in Chicago or whatever they're coming from. And then you've got the multi-generational guests, who come with, their brothers and sisters and their parents, and that works, right? When you got a 10-bedroom home that can hold 24 people, so you've got multiple generations, golf buddy trips, those sorts of things. Obviously Scottsdale's got some of the best golf in the world, so we were the beneficiary of that, and high-end athletes, and things like that. So it's really that high-end clientele that we tend to serve.
Yeah, we did this with one of my, I think you were part of this group for a while, called Entrepreneurs Organization. I think we touched base on that. And we had a group, we went to Park City, Utah, and we stayed for, I think, 3 nights in a 5-bedroom and paid $7,500 for the 5 of us to stay there or something. So, but I mean, that's probably, how much are these places per night in Scottsdale? I mean, some of these places might be like a few grand to, more per night, right?
Yeah, I mean, over the last 6 months, just by way of reference, right? Like this year alone in 2022, as we record this, $1,482 is our average daily rent. Between peak and now, what would have been a shoulder in some part of the off season. So yeah, I mean, that is another segment that I'm really focused on from an execution standpoint. Being a former member of EO myself, and knowing the forum retreats, and now just to the remote workers and things. So really trying to get our bookings up, Monday through Thursday with those types of groups, the offsite meeting type groups. They're highly profitable. They respect the place, and we can sort of activate their stay, by helping them kind of book with, other things in and around town. So yeah, it's Yep.
That's great. So yeah, so just to understand a little more of the business model, I know a lot of people, they can, if I have a house, I can rent out a room in my house, or if I'm gone, I can have someone stay here or whatever. But obviously that's difficult to scale. What are some of the systems, or how do you guys scale this to where you feel like you've got a good, hey, we can take millions of dollars from investors' money to be able to go do this? And how does that all work? Like if somebody invests, just as an example, obviously not specifically your deal, but just, in the sense of like, how does this work? And what kind of returns? Do people start getting paid immediately? Is it usually there's kind of a time to kind of see how things go? I just love to understand how the investment is structured.
Yeah, I mean, so like in our case, my business partners, they're 4th-generation, real estate guys. So they're from, Chicago, did a lot of development. They moved down to Scottsdale in 2013. So they really came more from the real estate side and started to get into the vacation rental component in 2015. So really, I think that's more of where our, core competency, at its true core came from. So in terms of that, that's why we've kind of put a fence around, Scottsdale and Paradise Valley, is that when you really narrow it down, and then, there's 311 homes in the zip codes that we operate in that we want to buy or would be open to purchasing. And so we're more active with postcard campaigns, calling campaigns, really just, banging on the door, because for us, we've got sort of a triple threat, right? Like, hey, I'll buy your house. I'll give you, here's what I'm willing to pay for it. And we can just buy it outright. We also have the option for them to pledge their home into the fund via 721 exchange, which is an UPREIT deal, so they can sort of forego taxes. So if they don't want to pay the tax man, we've got an option for them, and then liquidity to get out, down the road. And the third one is, well, maybe we'll just manage your home, right? So maybe we can just manage it for you. So that's how we, that's kind of what our strategy is in terms of scaling that component of it. It's like any real estate acquisition firm, especially in the single family space, it's a lot of moving parts, because we are going to renovate more often than not. We're going to target and buy homes that haven't been renovated recently. Like one of the acquisitions we did recently was a 7-bedroom home. It was 6,500 square feet. We went in, we moved some walls around, added a bedroom. These aren't huge renovations, but it's enough to sort of, we know what the guests, like the backyards is usually a thing that's where you pick up a lot of juice, because you turn it into a resort, the backyard into a resort basically. And that's what moves the needle on ADR. So if you know where to invest the money, it's what makes it sort of different in this space.
So you said backyard into a resort. So is this like a bocce ball set, or is this like you're putting a full sauna and a pool, and like what are you doing in the backyard?
Yeah, I mean, most of these places have pools, so we'll refinish the deck. Or if the pool's not good enough, we might tear it out. I mean, we don't like to do that. That's a lot of work, but we're talking bocce ball, we're talking pickleball courts, putting greens, certainly like an outdoor kitchen. It just make it with misters and things. You make it a place where people can go to chill out. Because I think that's another big component, is that people just want to be together, but they still want those resort-like amenities. And so that's what we've seen is what really moves the needle on the amount you can get per night. It's just, when you offer that stuff, it really does create this very distinct, difference from just some random rental house.
Yeah, it's interesting because when we travel, people are looking, especially these types of travelers, it's high-end business guests that do retreats together. It could be a family that's, high net worth, and they're looking for an experience more than, they can go stay anywhere, but they're willing to pay. And people that have resources will pay for a pickleball court or a really nice pool or bocce ball or whatever these things are. That's like, oh, that just kind of makes it really pop. So I think that's awesome. Let's talk for a minute about just some of the challenges of this, because every business has its challenge. On this show, the Money Mailbox Money Show, we talk about all different types of investments for passive investors and just things people should know. So, obviously, as we're getting into, a lot of people are talking about a recession. I know the recession in 2008, 2009 hit Arizona pretty hard.
Yeah.
What do you see kind of going forward? Do you think that things will just kind of sail on? Do you think they'll slow down? Do you think what do you kind of foresee for the future if we do have a recession?
Yeah, no, I think, I think that, the Phoenix Metro of 2008 versus the Phoenix Metro of 2022 are two completely different animals. What Phoenix has done a great job at, really, I think in large part due to them having to figure out how to recover from the last downturn, was that they have attracted big business, right? And so they've become a place where they've wooed many manufacturers. Intel's expanded their presence there. I mean, just a few weeks ago, Virgin Galactic, announced that they're, doing their manufacturing facility there. Quite a few Korean companies and Chinese companies in town. So it's just a different place, and the economic base is just much stronger. So with that being said, I think like many of the, really hot markets around the country, there's probably 10% of the values or the prices that have been paid in the last 6 months that was sort of, just fluff. It's as we speak, literally is disappearing. And to be honest, it's good for us because we were, we really felt we had to we were sitting on the sidelines, for months here, kind of waiting for this thing just to cool down a bit. And that's now upon us. So, could the prices go backwards in the Phoenix metro area? Yeah, they could, and they might, and I wouldn't be surprised if they went back, even after removing that 10% fluff that I think is there, another 10 or 15. But I just don't think they're going back 30%. And that's why we like to source deals off market, find unique situations where, and especially when you get the more expensive the house is, there's a lot more play there, right? And so for us, just sticking to fundamentals like replacement cost and those sorts of things, I really feel good about it. I feel good that this is a market long-term, independent of this next recession, is just not going anywhere. It's a place that people want to be. Significant capital is being invested from any number of directions, and as that's why we're both in this space, right? I mean, I'm a believer of real assets and alternative assets, and I just feel like it's a good store of value in the long run, and that's how I approach it. And I think that this market will be able to withstand it. With that said, it's also why we like the luxury side, is that the rich will get a little less rich, but it won't change how they behave.
Yeah. So that makes a lot of sense. Obviously things look different than they did in 2008, 2009. I'm curious about the kind of the structure of the investment. So obviously I'm familiar with multifamily. That's our business primarily. We also do an ATM machine fund. There's some other stuff that we do, but is this primarily a similar type of thing where there's a cash flow with appreciation and it's, 5 to 7 year type of thing? Maybe not speak to, to your specific investment, just, but,
Yeah.
I'm thinking like kind of mid to high teens kind of general returns. Is that kind of generally what you guys do? Is it less? Is it more? Is there other tax things? I'd love to just know a little bit more about how it
Yes.
works.
Yeah. So for our strategy, there is some forced appreciation. So we usually will go in, acquire the asset with bridge debt, construction loan, right? So we'll pay 8% for the debt there. And then we'll perform whatever renovation, so that's, 60, 90 days. So, no cash flow, obviously, while the asset's being repositioned. And then when we refinance with long-term debt, right now we're able to get, because it's an investment asset and we're sort of, over the limits of all the other, good financing we could get in terms of just the Fannie Mae, Freddie Mac sort of stuff. It's 65, 70 LTV, and the rates right now are at about 6.25. So, for us, with all that being said, it's still, these are still generating 16, 17, 18, 19, 20% cash on cash returns. Even at those lower LTV levels, right? So it's that's what I'm saying. That's why I love this business model. I just feel like there's so much more play, right? Like, and for me, I'm an execution guy, so I just know like when you really tighten down your execution too, and how you, things like, penetrating like the entrepreneurs organization and really bumping that occupancy up, pushing it into the 70s with good you can really, really move the needle. Whereas, as in multifamily, it was like that in 2014, 2015. It was a wonderful thing. But right now, man, you got to be really, really, really good. And the tolerances are really, really, really tight. And there's guys who can do that. But I like the fact that this is sort of a transition's taking place, right? That the way that people travel, where they want to stay and their preferences. I've always loved that stuff. I love when a shift is taking place, because I feel like that's where the opportunity lies. And this strategy, that's where we're at.
Right.
There's not a lot of people yet who've perfected. There's a lot of amateurs out there that are trying to do it, but you become pro at this strategy. It's extremely lucrative for all parties involved.
There is a lot of growth, and it's been happening for years, but in the sharing economy, whether it's Turo with cars or it's, Airbnb, kind of what you guys are doing. And I think it's, like you said, it's something that you guys are kind of doing something unique. I'm sure there are other groups that are doing it, but as you get there and you're doing it kind of ahead of other folks, it really gives you a lot of scale. And I do think that market will continue to do well. And I do think, there's so much money out there. The people that are wealthy have a lot of money. They're going to keep traveling the way they have. And especially now that COVID's over, everybody's kind of been tired of just staying at home for, some places like in California for a couple of years. It was crazy. But so awesome, man. Well, I appreciate you coming on our show. I know we just have a brief time to go over this, but I also wanted to just ask, I know you've been in the investing world a long time, Lance, and I just want to see, as you're giving advice or you maybe even a resource or book or anything that you would just suggest, for investors as they educate themselves, whether about this investment or about another investment, just anything to kind of, that's something that's maybe helped you over the years to become a better investor.
Yeah, a book that I'd read a few years ago that I think is wonderful, and maybe for whatever reason sort of overlooked by many, is called Unconventional Success: A Fundamental Approach to Personal Investment, by David Swensen, who ran the Yale Endowment for years.
Yeah.
Okay. So, that in terms of investing in independent of Ben Graham and, all the letters that Warren Buffett, a value investor, that's the stuff that sort of gets me excited and it just makes sense to me. This book really changed how I sort of looked at investing holistically. And he obviously wrote this and sort of translated it from that institutional pension sort of, or endowment sort of looking at the world into like, well, how does this translate for your everyman? In fact, my new podcast, Death to 60/40, which, we'll have you on, Bronson, to chat about the same, but it's, I feel like that's what he's really hit at, is that there's another way to build a portfolio than, just stocks and bonds. You got to look at this thing differently. as to, and really the importance of asset allocation and diversification, which may at times be somewhat hackneyed, but you can't overlook the fact that they're super important, and security selection less so. And I think that most people wake up in the morning, they think they can somehow time the market, beat the market. I'm just not smart enough to do that personally. So that's why this book, of course, resonated with me, because it's like, I can't do that. I don't have the attention span to think that way.
Yeah. Yeah. Dave Swenson. Yeah. I don't think I've read the entire book, but I read some of it. And, he worked with the Yale endowment fund or something and grew it like 10 or 20x, or was it, I may have getting the story mixed up. But
no, totally. I mean, it's the best performing. He's the best investment manager of all time. Unfortunately, he passed away a few years back, at a pretty young age, all things being equal, but nonetheless, yeah, I mean, it's, thinking and investing like the endowment people invest, which of course inherently means, they've got all the time in the world. And I know we don't, as humans, we do definitely have there's a time frame, but I think we'd all be better served to do all we can to have a little bit more of a long-term approach to how we invest. And I've spent a lot of conversations with investors, much like you do. That's always my biggest frustration walking away from most conversations is most people are way too myopic, and they're just way too focused on what's right in front of them, and they're not looking at the big picture. And I think that's unfortunate, because I think that it ends up, harming them more than helping them.
Absolutely. Well, Lance, I think what you're sharing is 100% true, and I believe it wholeheartedly, is that it doesn't matter necessarily the investment that you're invested in, is what does it do for you. And when you learn stuff outside of traditional investing, you learn about things like this short-term rental fund or other things. I mean, I love being involved in different types of assets because of what it allows you to do as an investor. So really appreciate you coming on today. I just appreciate all the value you've added over the years to my life, just through being involved in funds and different things that we've done in the past, as well as just what you're doing now and how you're really committed to helping people to grow as investors. So just want to encourage everybody to reach out to Lance to hear about his investment. And he's got his podcast coming out, the 60/40 podcast, which I will be on as well. But Lance, how can people get in touch with you?
Yeah, I think the easiest way, just, shoot me an email, lance@parsonsvillas.com, pretty simple. And yeah, more than happy to chat. Once again, I won't hard selling anything. In fact, I find myself talking more people out of investing than talking them into it. Should I take out a home equity? No, you should not do that. Okay. I know you're excited, but you don't do that. That's probably about it.
Right. No, we gotta talk them down sometimes. They get it. So awesome, Lance. Well, I appreciate you having you today. It was awesome, man. Look forward to being in touch and hearing more about your fund.
All right. Thanks, Bronson. Take care.
Thanks. So Lance Pederson's a great guy, as you can see, really committed to trying to create value for investors. And I think one thing that I really took away from this interview was, again, it's really important to look at things that you're not familiar with. I don't think I found any other short-term rental funds, right? I mean, it's hard to do single family houses or smaller or even large houses and put them in a fund and do something like this. So I've kind of heard rumblings of them here and there, but I think this is the first one that I've seen. But what I like about it is this model is pretty high cash flow. They also do cost segregation. They use other tax benefits that they can use. And if you're buying in the right market, I mean, I think the biggest thing is it's important to have some diversification. I'm super heavily weighted in multifamily, particularly in certain markets, but I do invest in other things. So we've got our ATM machine fund, which is very high cash flow. If you haven't heard about that, that'll come out probably about November. Awesome, 100% depreciation and no recapture, very high cash flow in that deal. I also invest just on my own in a Bitcoin mining fund. That's more recent. I have a self-storage fund that I'm involved in. I have some other stuff that I do as well. I do a lot of precious metals. So I think it's important to have different things. And my friend Mark Moss says this as well. It's important to have some things that are outside of your primary focus. So again, if I'm super bullish on multifamily, I should probably have something in single family or in short-term rentals or in other types of things as well, right? Because what if I'm not as right as I always think I'm right? I always think I'm going to be right in everything I'm doing. Everybody's passionate about what they're doing, but what if you're not right? What if you're wrong? What if you're not as right as you wanted to be? Having some diversification can help you. So I hope this really encouraged you. If you haven't checked out our new report, which is called How to Use Inflation to Your Advantage. I just got the kind of the promo sheet here. They've printed up the full one here, but this is it right here. How to Use Inflation to Your Advantage. It's a 53-page report that I wrote basically about how to actually not be a slave of inflation, but to have it work for you. So BronsonEquity.com, it's on the homepage. You can download it for free. So check it out. Thanks for taking the time to educate yourself. Look forward to seeing you on the next episode.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to BronsonEquity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.